Welcome to Talk Tickers. You're here for a deep dive into the latest earnings calls. And today, we're unpacking the second quarter fiscal year 2025 results for Pathward Financial. Our goal, as always, is to give you those crucial insights minus all the jargon. So let's jump right in.
Absolutely. So Pathward Financial, they had a strong Q2. Really significant growth compared to last year.
Okay.
They reported earnings per share of $3.11. That's a notable 21% increase.
21%. Wow.
Yeah. And net income hit $74.3 million. We also saw a 7% rise in their non-interest income.
Right.
And net interest income grew too by about 5%.
Okay. So both sides growing.
Exactly.
Yeah.
And what's interesting is that both their net interest margin and the adjusted net interest margin expanded.
Mm-hmm.
If you look at the year so far, non-interest income makes up a pretty substantial chunk, 45% of their total revenue.
Almost half then.
Pretty much. Return on average assets stood at 2.69%, quite healthy. And return on average tangible equity was, well, really high at 43.79%.
Over 40%. Okay.
Yeah. And because of all this, they've actually bumped up their earnings guidance for the full fiscal year 2025. The new range is $7.40 to $7.80 per diluted share.
Okay, so the headline numbers certainly look good. Sounds like a really strong quarter overall. What were some of the key things driving these results?
Well, a huge factor was their tax services business. Management actually called it a fantastic quarter, and a lot of that was fueled by, a really successful tax season.
Right, tax season dependency.
Exactly. And they hit a new record, over 42,000 independent tax offices now in their network.
42,000.
Yeah. And if you dig into the numbers a bit, the non-interest income from their refund transfer and refund advance products, that jumped 13% year over year.
13% just from those products.
Those 6 months ending March 31st, yeah. And the actual refund advance originations grew by over $100 million. That's a 7% increase.
Okay.
So all that together pushed total tax services revenues up to $85 million. That's a 17% increase compared to the year before.
17% growth in tax services alone? That's significant.
It really is. And what's also noteworthy is they mentioned favorable loss rates in this area. They put that down to improvements in their underwriting models.
Better risk management paying off?
Seems like it. And that efficiency really flowed through pre-tax income for tax services, grew by 29%, hitting $47.6 million. So yeah, that segment is clearly a major engine for them right now.
That's really impressive on the tax side. What about beyond that? Any other sort of strategic moves impacting things?
Definitely. Another key area is their focus on optimizing the balance sheet.
Okay.
They talked about a strategic partnership they have for growing their renewable energy loan portfolio.
Yeah.
Apparently that's going well. Strong originations, solid pipeline for future deals.
Interesting diversification, renewable energy.
Yeah. And they also made a strategic call to sell off a portion of their working capital loan portfolio. Seems they took advantage of some good market prices there.
Okay, capitalizing on the market.
Right. And that move freed up about $190 million in liquidity. The plan is to redeploy that cash by the end of the year, putting it into assets they think will offer better risk-adjusted returns or, just improve the overall return on assets.
So actively managing the portfolio mix.
Exactly. It's a crucial part of their current strategy, proactive management.
And what about their core business, the lending side? How profitable has that been?
Good question. Their net interest income, that's basically loan income minus deposit costs, that increased by 5%.
Okay, 5% growth there.
Yeah, and he attributed this to an improved mix of earning assets and just better profitability overall.
Makes sense.
Their net interest margin, which is that key measure of lending profitability, right? It rose to 6.50%. That's up from 6.23% same time last year.
So margin expansion too?
Mm-hmm. And the adjusted NIDAM also saw a healthy jump, 33 basis points.
Okay. And the loan book itself, how much did that grow?
Well, the total loans and leases increased slightly to $4.5 billion. But if you strip out some insurance premium finance loans from the prior year figures, the underlying growth was actually more like 15%.
15% underlying growth. That's solid.
It is. And interestingly, management said they aren't really seeing any red flags in the portfolio, nothing suggesting an economic slowdown yet. Performance metrics are still, within their historical ranges.
That's good to hear. What about credit quality provisions?
Yeah, the allowance for credit losses, if you exclude the seasonal tax lending, was 101 basis points of their loan portfolio.
Okay.
And their actual losses, the net charge-offs on an annualized basis, were 61 basis points. So looking pretty controlled there.
Okay. So core lending seems stable, profitable. How about the other side of the coin? Expenses and deposits.
Right. Well, expenses were pretty well contained. They saw a very modest increase, just 1%.
Only 1%.
Yeah, and they said this was mainly down to continued investment in their tech infrastructure. You hear that a lot these days.
True. Technology spending is key. And deposits.
On the deposit side, the total amount held directly on their balance sheet actually decreased compared to last year.
Oh, interesting. Why was that?
Well, partly it was the return of those economic impact payment deposits that were kind of temporary, and also a reduction in wholesale deposits.
Okay.
The average amount of deposits they had sitting at their partner banks was about $66 million. That's a pretty big drop from the $783 million they had the year before.
Wow, quite a shift in where those deposits are sitting.
Yeah, definitely a change in the mix there.
It sounds like they're managing their capital quite carefully then. What about their overall financial strength, liquidity, and how they're returning value to shareholders?
Yeah, they seem to be in a good position. They reported a strong liquidity position, nearly $3.9 billion readily available.
Almost $4 billion in liquidity.
And they were actively buying back their own stock during the quarter too. They repurchased about 576,000 shares.
At what price?
Average price was $78.11. And that brings the total for the year so far to almost 1.3 million shares repurchased.
So significant buybacks continuing.
Definitely. Their strategy for capital management, they're targeting a tier 1 leverage ratio, the key measure of bank strength, right? Closer to 10%. And they expect to keep up these share buybacks at a pretty high rate, maybe 80-90% of earnings for the rest of the year while they work towards that capital target.
Okay, clear capital return strategy.
Yeah.
So finally, based on all this, what's the overall picture management is painting for the rest of the fiscal year?
Well, as we touched on earlier, they raised their EPS guidance for fiscal 25. That new range is $7.40 to $7.80.
Right.
Now, that outlook, it kind of assumes a few things. No more rate cuts from the Fed.
Okay, stable rates assumption.
Yeah, that their net interest margins will stay above fiscal 24 levels, an effective tax rate between 17 and 21%, continued share buybacks, obviously, and keeping expenses well managed while still investing in tech and risk compliance.
Got it. Any other color from the Q&A session?
Yeah, a few interesting points came up. Management highlighted that their tax business is getting more scalable, which helps efficiency and market share. They did note that higher IRS refunds this year gave them a boost, but maybe future growth won't be quite that high.
Managing expectations a bit there.
Exactly. In commercial finance, they stressed that despite all the economic uncertainty talk, they haven't seen credit quality slip.
Still holding steady.
In fact, they mentioned seeing more higher quality companies coming to them for funding, possibly because traditional banks are tightening up a bit.
Right, that potential flight to quality again.
Could be a benefit for their working capital group. And they feel pretty confident because a lot of their portfolio is secured lending.
Okay.
They also mentioned they haven't seen any big shifts in payment behavior from their partners' customers. They think maybe because a lot of that business serves, essential spending needs at the sort of lower end of the economy.
Interesting observation about spending patterns.
Yeah. And one more thing, they announced a new partnership. This was actually after the quarter ended. It's to originate online consumer term loans.
What kind of borrowers?
It's aimed at near prime to subprime borrowers through a marketplace model. So it fits with their existing partnership strategy, but they emphasized, careful monitoring of underwriting and reserves.
Right, expanding reach but managing risk.
Exactly. And even with potential rate cuts possibly coming, they think their NIM outlook is relatively neutral.
How so?
Because of that asset rotation strategy we talked about shifting into duration assets and loans, they think that will offset the direct impact of rate changes.
Proactive balance sheet management paying off there, potentially.
Seems to be the plan. Oh, and one last point from the Q&A. They see disruptions happening among smaller competitors in the banking as a service, or BaaS space.
Ah, the BaaS market shakeout.
Right. And they see that creating organic opportunities for them. They can be selective, maybe pick up new programs or portfolios without necessarily needing to splash out on big acquisitions.
Interesting. Taking advantage of market shifts.
Yeah, looks like it.
Okay, so pulling all of that together. If you had to give the main takeaway for someone trying to get a handle on Pathward Financial right now, what would it be?
I think the key takeaway is that Pathward really appears to be firing on multiple cylinders. Their strength isn't just coming from core lending.
Right. The tax business is huge.
Exactly. It's providing a significant boost and shows valuable diversification in how they make money. Their proactive balance sheet management, like the renewable energy push, suggests they're thinking ahead about growth. The higher earnings guidance, the ongoing buybacks, those are generally positive signals for shareholders, right?
Typically, yes.
And the comments about commercial finance, seeing better quality deals, plus the stable payment trends, those offer some interesting, maybe slightly counterintuitive insights into the broader economy.
Yeah, definitely food for thought there.
And finally, their sort of opportunistic approach to partnerships like in online lending and grabbing chances from the Bastis disruption, it paints a picture of a pretty nimble and adaptive strategy for growth going forward.
All right, now for the part of our deep dive where we get a bit creative. This is not financial advice. Based on everything we've just heard about Pathward, what's an outrageous but plausible trade idea that springs to mind?
Okay, here's one playing off their strengths. Given Pathward's proven ability in tax refund processing and how they're carefully stepping into near-prime, subprime consumer lending via partners,
Right.
how about this? Consider a long position in Pathward Financial, paired with, say, a short position in one of the big traditional credit card issuers that's heavily reliant on prime borrowers.
Interesting pair. What's the thesis?
The thesis is, if the economy tightens up, Pathward's niche focused on essential spending flows like tax refunds, and their adaptability in lending models for maybe more resilient borrower segments might hold up better than a traditional prime-focused credit card company facing potentially higher defaults or lower spending.
So, betting on Pathward's niche resilience versus prime sensitivity.
Kind of.
Yeah.
But remember, just a thought experiment. Definitely not financial advice.
Absolutely. Okay, here's another angle, picking up on that renewable energy theme.
Go for it.
With Pathward making that clear strategic move into renewable energy lending and all the focus now on sustainable investing.
Yeah, ESG is everywhere.
Exactly. So maybe explore a long position in Pathward Financial combined with a short position in perhaps a traditional energy company that's still heavily tied to fossil fuels and hasn't shown much movement towards renewables.
Okay, the green transition play.
Right. The rationale is that Pathward's pivot could let them ride the wave of the growing green economy, while those traditional players might face increasing headwinds from regulations, investor pressure, you name it.
Betting on the strategic direction, essentially. Pathward leaning into the future, the other potentially stuck in the past.
Something like that. But again, purely for informational discussion, absolutely not financial advice.
Understood. Always important to state that.
So some really thought-provoking ideas there. Just to quickly recap the core story, Pathward Financial delivered a robust second quarter.
Yeah, driven by a fantastic tax season performance, for sure.
And showing some promising developments in their lending book and the strategic initiative like renewables.
And they've raised their outlook for the year and are actively sending capital back to shareholders via buybacks.
Exactly. So key things to watch going forward.
I'd say definitely keep an eye on whether that tax business momentum continues. Also, how effectively they actually deploy that $190 million in liquidity they freed up.
Right. Where does that money go?
And, of course, the growth trajectory of those renewable energy lending ventures. See if that partnership really takes off.
Makes sense. So what really stood out most to you in this deep dive on Pathward? Any particular angles you'll be tracking closely? We always love to hear what you think, too. Feel free to join the conversation. Thanks for tuning in to Talk Tickers today. We'll be back soon with another earnings call breakdown for you.